Hi and welcome back to the channel today. If you've never visited before, my name is Neil McCoy-Ward and I focus on macroeconomics. Now, I know many of you have been asking for a long time now, Neil, when is your next housing market video? So many of you are desperate for me to put one out. So what I've decided to do, rather than do a monthly update, because it's been 2 months since my last update video, today I'm going to give you a forecast for all of 2021 and definitely watch through all of the points because my forecast has changed somewhat in the last few weeks. That's why I'm getting the content out to you today. And if you are in my private community, you've already had some of this information, so you're ahead of the game. And if you haven't already joined, the link is in the description below. We cover all things finance. Okay, so with that said, let me talk about the most important thing that has changed. And then we're going to go into a screen share and I'm going to go through all the fundamentals with you. So have I changed my opinion on there being a huge crash on the way? No, I haven't. I still believe we're going to see a huge crash in the housing market in the future. But what I have changed my mind on is exactly when it's going to happen. So I'm going to break today's video down into short term, medium term and long term, and we're going to look at all the different fundamentals from each one of these. I assure you this will be the most comprehensive housing market video that you will see on YouTube all month, so it is worth your time to watch all of this. So if you've seen my video about how the housing market crash will happen, it's got more than 1.8 million views on that now. Nothing really has changed from that video. All the fundamentals still apply. The only difference is the timeline. So I'm going to focus on the timeline a little bit later on. So one of the main questions that everyone's asking is, Neil, why are house prices just exploding up in value? What is causing this? And I'm very surprised, and this is another reason I'm making this video, that so many other people haven't explained this yet. So I'm going to explain it, and because it is very complex, I'm going to use a very simple example of this glass of water here, which I always have on my desk. So I've always got water. Now imagine here, this line is the monetary supply. So this is all the money that exists in, let's say, the United States in US dollars. Now, the housing market can only go so high because there's a limit on the amount of money that exists. So what happens then is, let's say the government wants to borrow some more money because they need to do, forbearance and stimulus and all of that. The government has no money. So let's use this glass here. This is empty because that's the government. It has no money at all. In fact, it has a deficit, which I can't even show with this glass. So what they do is they go out to the market and they issue something called treasuries or bonds. And then people will buy those, and they are basically just contracts to say in the future, the government, we will pay you, the people, back with interest. So that is how it normally works. This time around, though, that hasn't happened. What's happened is the government have gone to the Federal Reserve. And here's the Federal Reserve, all right? It's not like this little cup. This is the Federal Reserve. It's like this giant water jug, because it is an unlimited supply, because the Federal Reserve creates money into existence, or currency as it's better known. So what happens then is we have this glass of water, so this is all the money that we're aware of, and then the Federal Reserve comes along and says, how much do you need, Mr. Government? Let me put in an extra 20, 30, 40% this year into the currency supply. So now you have this same amount of houses, but you have more money chasing those houses. So to me, this is pretty obvious and very common sense. What happens to those houses is they go up in value. So the first real warning that I have for everyone is, if you have money in the bank and you're saving for a house, just be aware that we may see as much as 8, 10, even at the absolute most 12% inflation this year. And this isn't measured by the CPI, this is in terms of real inflation of what is actually happening. So that means that your money in the bank, if you're saving for a house deposit or anything like that, or even if you just have savings in the bank, they're going to become worth a lot less this year. So be very careful with that. So let's go now to the screen share, and I'm going to start showing you all the data, all the facts around this then. Okay, so the first screen that I want to share with you then is from the Fed. So this is the Federal Reserve Bank of St. Louis. And this is their economic research. And you can see here, this is the S&P/Case-Shiller US National Home Price Index. And we can see exactly what's happening here. Just look at the sheer scale of the home price rises of late. And you can see it's just going up even higher here. Now, when we cross-reference this, so if we go to the M1 money supply here, and you can see, again, we can bring in M2 and everything else, but I'm just showing you M1 because this is a lot easier to show you. You can see this nice even trajectory, even though it's quite substantial. And then we got into 2020, and just look what happened in 2020. It really started to just climb with all the new stimulus and everything else going on. Now, remember this pattern here, because I'm going to link this to another diagram later on. Hi, if you're enjoying this video so far, could you do me a quick favor and just click the like button for me? It really just helps the video to get ranked. Thank you so much. So I want to just show you Realtor.com, and this was their market summary for December of 2020. They haven't put out January yet, but when that comes out, I'll also assess that. And you can see we had a 13% year-on-year increase to a median list price of $340,000. Now, this really is concerning because prices are just running away. Now, if you're a homeowner already, obviously this is great for you, but the people that I'm really concerned for are our younger people, our next generation as well, who simply are priced out of the market. They cannot afford to buy. And this is just running away. And some of the reasons for this are historically low interest rates, like I covered last time, very low levels of inventory. And then, of course, here we have, look at this, days on the market is down to 66 days. So a 16% reduction. Again, that's huge. And then active listings, look at this, 40% down year on year. Now, a lot of people aren't mentioning why this is, but I personally feel it is down to forbearance and the rent moratoriums at the same time as a lot of people becoming unemployed or losing their jobs, and they know they won't qualify for a new home loan. So really all of this is just building up this pent-up energy. A lot of people are calling it pent-up demand. I would say more accurately to describe it is pent-up energy, because once all of this eventually lets loose and the free market is allowed to do its thing again, inventory levels will rise, interest rates will have to rise in the future. They won't happen for a while yet, and Jerome Powell has already said that these won't happen in the near future, interest rate rises. However, we probably will see some small rises as we go through the year, maybe 1%, maybe 2%. I wouldn't expect much more than that as it stands right now. But again, if you want to see any of this data for yourself, just go into Realtor.com and go into their research portal, and you'll see some of these reports. Again, it shows you hotness from hot to cold, which markets are hot, which are cold. So you can look this up for your specific area, because a lot of people ask me, Neil, tell me about this city or that city. And you have to understand every city is its own housing market in each county, in each state within the United States. And of course, the United States isn't just one big housing market. It is many different markets. So you really should do your own research. And I'll link you as we go through to some of these research tools that I use. So let's take a look at the Realtor.com housing forecast for 2021 then. And I'll let you know if I think this is quite accurate or not. So you'll remember previously I was expecting a large decline in around about March to April time of 2021. That was for the United States. I currently do not believe that will happen now. And the reason for that is not because all the analysis I did was incorrect. In fact, 99% of it still stands. It's just that 1%, which is the timeline. The reason the timeline has been pushed back is due to all this new stimulus, as I mentioned at the start. It's due to the rent moratoriums. It's due to forbearance. These things keep getting pushed down the line. They keep getting extended. And I wouldn't be surprised at all if under a Biden presidency, these things get extended even further. I think the rent moratoriums will definitely keep getting extended. But one thing that can't get extended and keep getting extended is the property taxes. Now, whether they're just going to be forgiven, I highly doubt that. When all the cities and the counties and the states are in huge debt, I don't think they're going to be forgiven. And of course, this creates liens, which you have to pay interest on. There's a lot at play here. There really is. And another thing that I don't believe a lot of people are talking about is another short-term issue, and that is cash-out refinancing. So I personally believe, looking at the data and the statistics, the reason that a lot of people aren't suffering in the way that you would expect them to right now is because they're refinancing their homes with all these uplifts that are going on. They're refinancing, getting these lower long-term rates, which is a good idea. It actually is a good idea to get a long-term fixed rate, low percentage interest rate as long as you don't intend to move house. So if you're intending to move house in, say, 5 years, so you're thinking of buying now, selling in 5 years, you may want to reconsider that or think a little deeply on it, because that moves into my longer term forecast, which is not as rosy as my short term forecast between now right through to the summer or fall of 2021. Now I've sort of turned it around and said, I think we're actually going to have quite somewhat of a boom as we go through 2021, at least the first half. But again, we are going to see a crash. It's just when this will occur. And the other thing is the crash is going to be a lot worse than I initially thought and forecast, because of all of these new programs and all of these delay tactics. You are basically just building up all of this energy, and eventually this energy will have to be released again into the free market, because we are a capitalistic society. We're not a socialist society. So Realtor.com are actually forecasting 5.7% appreciation, or existing home sales they believe will be up 7%. I think we may actually see a larger appreciation than 5.7%. A lot of the forecasts I've seen have been about 5 or 6% for 2021. I actually think that we're going to see probably, and this is just a rough estimate, a 0.8% increase across the board month on month. And the reason I say month on month and I'm not saying for the year is because they will increase until they won't. And what I mean by that is there will be a turning point, there will be a tipping point. And I'm going to talk about some of the more medium-term things now, but there will be a turning point in all of this. So moving more heavily into the medium term then, which is the next 6 months to 9 months, we can already see that the inventory available, and again, this is the Zillow, we're on Zillow now, we're on the data center. We can already see that the inventory is down a huge 34.3%. And this is what is causing, or at least helping to contribute towards these extremely high housing prices. Again, it's a very simple supply and demand dynamic. When you don't have that supply available and you have a lot of people interested in buying, it simply pushes the prices up. So again, what do you think is going to happen when this reverses and a lot of this pent-up demand or a lot of this pent-up energy, these houses go back to the market? You will reverse this curve. Another point is the foreclosure ratings at the moment. So if we look at a typical year here, and we can see what the foreclosure rating was. Well, in fact, let's get back to 2008, 2009, 2010, 11, 12, when we were in the last housing crisis. You can see what the sort of foreclosure activity was like. And again, I don't see, this the way a lot of other forecasters see it. I don't see a 2% or 1% as being a major problem to the housing market or the prices. What I see as a problem is when you take the forbearance, the property taxes, the unemployment, the rent moratoriums, and you have all of these coming together at the same time as lumber prices are up and all sorts of other prices are up, supply chain issues, lack of inventory. This is what I see as the issue. It's not the 2% here, the 1% there. It's when you start to add all of these up and you look at the timeline for when all of this energy will be released and the free market allowed to continue. This is what you should look out for, because look, 2020 saw the lowest amount of foreclosure activity that we've seen in over 15 years, if not longer. And is that because 2020 was a booming year and no one was foreclosed on because they were so wealthy? No, we already know this. We saw the unemployment numbers. And in fact, let me pull these up. I actually don't agree with these statistics from the Federal Reserve. So they show an unemployment rate of 6.7 right now. But this is the U3 rate, which is very different from the unemployment rate, in my opinion, because they exclude a lot of people. So again, even if we look at 2020 here, we saw that it went up to 14.8%, again, U3, before coming down to 6.7%. And again, people believe this is going to plateau a little bit. I personally don't believe that. I believe it will dip a little bit later on as a result of employment scarring, where a lot of the employers will start to suffer, lay off people. And of course, people are the consumers. They spend the money. They don't have the money. Again, this creates a self-fulfilling negative cycle downwards. So I won't get too much into that right now, but let's look at alternative statistics then. And this is Shadow Stats. If you've never seen this company before, this is from John Williams. I highly recommend. Great researcher. And actually, you can see his statistics here. He puts unemployment currently at 26%, and he put it at 36% during this crisis, during 2020. But you can see at December, as of December 2020, his rate shows 26.3%. I actually prefer, so that I can be quite unbiased in all of this, I prefer to take a mean average between the official, so this is the U3 rate that the government puts out, and between shadow stats. So I like to go somewhere just above U6, which I believe is the accurate unemployment rate. So let's just say it's around 15% right now, and that's an accurate unemployment rate. The question you've got to ask yourself is, what will this do to prices? What do you believe this will do to home prices as we go forward through 2021? And all of the benefits and everything else around the unemployment finally comes to an end. The government just allows the free market to correct. I think we're going to have a lot of issues. Now, one thing I hope happens is that a lot of people, and this includes you if you're in this boat, start to retrain and reskill now. Again, I won't go into too much detail on this and my recommendations on sectors to go into, but you can check that out on some of my other videos. But I do believe that we're going to have a problem with this, all of this unemployment, where people simply won't be able to afford to actually buy houses in the future, as we're having these, again, runaway prices. The prices are getting higher and higher all the time, and it's simply pricing people out of the market, and it will continue to do so at a time when people have less money and there are less jobs available. Now, I do just want to come back to jobs and unemployment and things like that before we move on, because I do think this is crucial. And you'll remember I was one of the first people to actually start tracking the migration patterns. It was actually one of you, my subscribers, who said to check out U-Haul. This was a long way back, March, April time. And I called up U-Haul and I started tracking all of this. And then throughout all of this now, a lot of people start looking at migration patterns, and it's definitely contributed to a lot of the data. Now, you can actually find migration patterns on redfin.com, and again, go into the data center on Redfin, and you can see all the migration patterns and where people are actually leaving from and where they are going to. So just to show you an example, here we have New York here. 36% are moving to Atlanta. So that is a staggering number, 36%. And then, of course, on the West Coast, we have a lot of movement in California presently. And I think this is going to continue to happen. In fact, we have some more data here. I'm just going to move over to Alto's research here. And you'll remember I've been tracking LA quite a lot. I've also been tracking Boise, Idaho. And this was one of my top tips for you, especially if you're an investor or you're looking to buy a home. I said Boise, Idaho, back in March, April time would see these huge gains, and that's exactly what's happened. Boise has just exploded in price, and even here we can see last month it was a very strong seller's market, and it has started to reduce now. But we'll see what happens here. I still believe this is going to be a strong seller's market for a while yet. I mean, look how far it's got to go before it becomes a buyer's market again. And look, let's look at this. Inventory. What is the pattern again? It's inventory. It is down. Look at 2018 here. You know, your 7-day average was 347. Your 7-day average now is 81, just as a comparison. And again, these are seasonal waves as well here. But it just shows you, just from tracking other seasonal waves here, look at this 300, we have a 350, we are down to 80. This is what is causing the house prices to explode up in value. And again, just linking this to the jobs then and migration around jobs, we're seeing a lot of the tech industry move. So a lot of people ask me, how do you know, Neil, when house prices will come down in a certain area? And the answer is quite simply that you have to track a lot of things such as jobs, industry, and a whole host of other things. But if you just look at the companies in that area and where the high-paying jobs are, if those companies are still doing well, then you can expect the housing market around that to do well also. Now, let's use the Bay Area, for example. So let's look at this here. What's happening currently? Well, a lot of the tech companies have been leaving. They've been going to Texas, for example. They've been going to other locations. What do I think will happen in the Bay Area then if a lot of tech workers don't need to live there anymore? I think long term we'll probably see a reduction in prices in that area. And you can see already the mass migration going out of the Bay Area to elsewhere. So we'll just use San Jose as an example here. And you can see where people are going. They're going to LA, for example, San Diego. We're having people move over here to Austin in Texas, again, because that's where some of the jobs are going. Phoenix, again, that's where some of the jobs are going. Las Vegas. And then as we go north, Portland, Oregon, and Seattle. Not surprising at all that many of the people would be moving from the Bay Area into these other locations, especially as a lot of people have realized now that where they've gotten stuck during this crisis is not where they want to be long term. And the lockdowns and things like that, some people are really struggling to actually stay in these locations, especially the studio apartments, the one-bed apartments. If you're stuck in a place like this long term, again, if you look at the health data around this, a lot of people are really struggling mentally with being in such a small space. So a lot of people are trying to move out to get more house or more home, whether that's a condo or a small house, for their money. So we're going to continue to see this sort of migration as well. So we'll see more of these apartments, more condos in the big cities that I believe will come down in price as we go through the year, especially long term. I think, again, it's simple supply and demand. If the jobs aren't there anymore in the big cities, if the businesses continue to collapse, you haven't got the retail, you haven't got the hospitality and the leisure industry. What reason is there for people to be in the big cities if all the benefits have gone? Another thing that I don't think enough people are talking about are the new permits being issued. So if we look at what happened during the 2008 crisis, you can see from about 2006 onwards, building permits decreased massively on a huge scale during the crisis. And we also have to look at, why would builders be building right now? Well, it's because prices are rising so rapidly. So it's highly profitable, again, capitalistic society, highly profitable to be building apartments and condos and houses right now. So you'll see a lot of home builders moving into the market, buying land and building these houses. Now, in terms of acquisition of land through to building, the time frame varies somewhat, but let's just say that the foundations have been laid. From that point on, you can expect about 6 months before the houses are available. So let's tie this in then with where we are right now. So here was Jan 2020, and then we went right down to April because there was so much uncertainty. A lot of industries ground to a halt, and now you can see we're up to 1,635, and that was as of November 2020, because again, remember, the FRED data is always a couple months behind, 2-3 months behind sometimes. So you can see the building permits are going up and up and up, and that looks to be in line with this trend. Yes, we had a big sort of spike here in June 15, but it's pretty much in line with the trend. So that tells us that we're going to continue on with the current rate of building, which probably isn't quite enough for what we need right now. So I would estimate more home builders and private individuals, private builders getting into the market to take advantage of these rising home prices. But of course, we also have to bear in mind supply chain issues. This is a real concern right now. There are supply chain issues. There are rising prices in materials. A lot of people are saying, why are these prices rising? It doesn't make any sense. It does make sense if you understand the example I gave you at the start with the water again. This is commodity prices rising. You have all of the commodities now that are just going up and up and up in value. And I still believe commodities are undervalued anyway, but you are seeing these rising lumber prices. You are seeing rising prices in other materials used for home building. So this is, again, another variable that's pulling up the housing market right now. But just as we come in to finish off these medium-term variables then, one thing I want to talk about is the rent moratoriums. These are causing huge issues. I speak to landlords every day in the United States, in other locations. And one of the big problems that are happening right now is a number of landlords are having to pay on behalf of their tenants, and the landlords are really struggling. They're going through their savings quite rapidly. The other thing is, and I don't know if this is all states or just a number of states, but I've heard this in 5 or 6 states already, that if the tenants don't pay their utility, so the electricity and things like that, the landlord actually has to pay those utilities on behalf of the tenants, which I was shocked to hear that. I must be honest with you, I was very shocked. But this is another thing that is also adding fuel to the fire here. And the last thing I just want to talk about before I come into the long-term forecast here and talking about this huge bubble is that I've actually read the full Biden and Harris housing plan. I've gone over that in detail. Now, there's a few good points in there. I really do believe there's some good points, but there's also some very concerning points. And I think that, it would be a mistake to go ahead with these points, shall we say. And that is to almost give a number of people houses or to let them put down almost nothing as a deposit. I do think this is a concern because as we do go into this downturn in the housing market, I believe a number of these people will just walk away from the house, especially if we saw, say, a 20% reduction or more to house prices. Why would they continue to pay these mortgages when the houses are underwater? It wouldn't make any sense. So I do think that is a concern. But one of the points was to help millennials to get onto the housing market, or young people, with a $15,000 bonus payment, or a grant as it's being called. Now, $15,000 is not a good idea. There's also a program in the UK called Help to Buy. And all this did, and we have the data and the evidence for this, all this did was pushed up house prices even further because people said, oh, I can afford more now. And again, we've just seen this again in the UK with stamp duty. It was taken off, so people just spent more because they say, oh, well, I've got this extra amount of money now to put onto the value of houses. So even in the UK, house prices have exploded, along with a number of other Western countries. But this is part of the new policy under the new administration to give $15,000 as a grant. And all this is going to do is to, again, push up house prices. I don't really think it's going to help too much for the young people trying to get on the ladder, because 15,000 is nothing when you look at the price rises that we've been going through and the average house prices now. So I don't really see this as having this big impact as, the new administration is talking about and how great this is going to be and helping people get on the housing ladder, because I really don't think it will help many people at all, unless it is to get by a very small place, a small condo, or a very small house with some sort of support elsewhere. Otherwise, I still believe that people are going to be priced out of the market. Now, as we come into the end then, the long-term trends, I still believe that we're going to have a huge housing correction in the near future. I'm not going to put a date on it exactly because I can't tell you precisely when this was going to happen. I did have a date before for you, which was around springtime of 2021, but now that's no way going to happen because of, again, all of this new money that's been put into circulation. All this will do is increase inflation. You're going to see a lot of price rises. And again, a lot of people are saying, no, we won't see price rises. That's crazy because we're already seeing the price rises. And you're intelligent people that watch my channel. You go to the grocery store and see what your bill is compared to a year or 2 years ago. You'll see that there's quite substantial food price rises already. So we're already seeing this inflation, and it will continue. It will also decrease the purchasing power of what you have in your savings account. And again, I'm probably going to make a video over the next few weeks about whether you should buy, whether you should sell a house, how to go about doing that. I'll also talk about the differentials between how you can actually profit from doing it. But again, this is all short-term thinking. Okay, in the long term, we are going to see a correction. So you've got to weigh these things up. Again, a lot of people are forecasting at the moment. There's some very good data here. And we even have a housing activity tracker here from Goldman Sachs. So we can see what's happened. The activity is up 40%. Now, if you don't think that's a bubble, then I don't know what is. That is a huge, huge bubble. Look what the bubble was like before. We had an increase in 5% here before we went into a decline during the last crisis. But the last thing I need to warn you about, and this is a huge, huge warning, is that the Federal Reserve are going to be the winners in all of this. So the Federal Reserve, and I'll show you why. And that's because, and again, here's the chart they're showing here. Now look at this. This is mortgage-backed securities owned by the Federal Reserve. Again, the Federal Reserve is neither federal nor is it a reserve. They create money. Remember my example? They've got this giant jug and they can just throw that into the monetary supply and just create as much money as possible. So here's what they've been doing. Look, prior to 2009, look at this. Let's go right back. there were no mortgage-backed securities. So what's been happening is, and this was a good lesson for them in the last crisis, was to buy these mortgage-backed securities. But you see, they never gave them all up. That was the point. It was QE, quantitative easing, and they were supposed to give all the mortgages up and give them back to the free market. It never happened. So we were never able to correct fully from the last housing crash because the Federal Reserve is holding up the prices. So let's move forward, and this is where it gets really crazy here. During 2020, look what's happening with the Fed buying all of these mortgages. Now, I won't get into how they buy them because it's very, very complicated. But they actually buy them or swap them with the commercial bank. So when you take out a mortgage with a commercial bank, you think they hold your mortgage, but they really don't. They sell those on to investors, or in this case, to the Federal Reserve. So the Federal Reserve are the ones really who are propping up the housing market right now. And they can keep this going for a long, long time. So even with my forecast that I'm giving you, the long-term forecast, this could be blown out of the water. If the Federal Reserve doesn't want the housing market to crash, then it won't crash because they can keep holding it up for a long, long time, for as long as the dollar is and reigns supreme. But eventually all of this will have to come down. It can't just keep going forever. It will eventually come down as the free market does correct, or as we move away from the US dollar into a digital currency. We are going to see some changes. We are going to see some movement. But the main thing for you to all be concerned is that the Federal Reserve owns 1/3 or more of all mortgages currently, and they may go ahead and start buying even more as we see difficulties with the banks in the near future. So I really hope that helped you today and that I fulfilled upon the promise to give you the most comprehensive data on the housing market right now, so you understand what's going on, why prices are high, why prices haven't come down, and how they may come down in the near future. If you want any more personal advice or one-on-one advice, you can contact me. For that, you can see the link below in the description for private mentoring sessions, or you can simply join our private community. I would highly recommend you do that anyway. Most people join the private community first, and then they may have a one-on-one session with me later on. But apart from that, thank you so much for watching today. Please remember to click the like button, subscribe to the channel for more housing market information, and apart from that, I wish you all the best. God bless, take care, see you very soon.